Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull bear point and figure market breadth summary chart for March 11th, 2018. Market breadth. With this past week's market advance, our bull bear point and figure ratio at 0.89 rose from 0.57 last week, advancing, but still within bearish territory. The total count of securities in bullish or bearish patterns increased 4% to 2,726. The count of bearish stocks decreased 14%, while the count of stocks in bullish patterns increased 34%. The Pirls P&F Market Breadth Summary Chart shows us a market now 6 weeks in bearish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly Pirls Stock Market Commentary via email free of charge, simply enter your name and your email address in the spaces provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 206 points for the 10th advance in 21 weeks. At a positive 141.92 points, it continues below all 8 tops in the last 30 months, continues above all 5 bottoms below minus 100 in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in accumulation mode, with average daily volume lower than the prior week. In the last 2 weeks, the Nasdaq had 4 accumulation days and 3 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode, on higher average daily volume. Momentum. At Monday 3/5 close, the CCI 20 daily in a Woody's uptrend within the plus or minus 50 range formed a zero-line reject long entry signal at a positive 157.68, up from a positive 21.61 last week. It rose for the remainder of the week. We will continue to follow the results of this trade simulation in next week's commentary, exiting when the CCI 20 daily falls below plus 100. In Woody's CCI trading system, 6 consecutive bars above or below 0 are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 97 weeks ago, while the daily CCI 20 began a Woody's uptrend 1 week ago. At Friday 2/16 close, the CCI 20 weekly presented a zero-line reject long entry signal for Monday 2/19 open. At Friday 3/2 close, the CCI 20 weekly fell to 85.7 from 106.21 last week, signaling the exit of our trade simulation at Monday 3/5 open. The result of this trade simulation was a gain of 13.86 points on the Nasdaq, or 83 cents per share of QQQ. The CCI 20 rose this week to a positive 124.27 and is currently outside the plus or minus 50 range for a new zero-line reject long entry signal. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: brokers and some tech on top, gold and silver, oil, and oil services on the bottom. Bullish, semis, and disk drives continue in the top 5. Brokers, networkers, and computer hardware have entered the top 5. Gold and silver continues in the bottom 5. Oil and oil services have entered the bottom 5. REITs has left the bottom 5. Bearish, Comp Tech and S&P Retail have left the top 5. Focus this week from www.zerohedge.com. Is a dollar funding crisis imminent? LIBOR OIS blows out the most since 2012. We recommend reading the article, but much of the first portion is reproduced below as an introduction. Call it the latest paradox of bizarro, centrally planned markets. On the same day when the Nasdaq hit a new all-time high, when the Dow soared, and when the payrolls report reincarnated the Goldilocks narrative with one flashing red average hourly earnings headline, surging jobs plus subdued wage growth equals an economy that can handle 10-year yields at or above 3%. One of the most closely followed leading indicators of an imminent funding crisis and global credit crunch finally broke above its 6-year range when the USD LIBOR OIS spread jumped 2 BPS on Friday, rising to 44.23 BPS. This was the widest this key spread has been since January 2012, when the latest European sovereign debt crisis was rolling the markets and forced the Fed to open unlimited swap lines with the rest of the world to avoid a global dollar funding crisis and, well, effectively bail out the world, which, according to the BIS, is synthetically short the USD to the tune of over $10 trillion for the second time in 4 years. The move will not come as a surprise to regular readers, as we have been covering it extensively since late 2017. Why U.S. tax reform will put even more pressure on dollar funding markets? LIBOR OIS blowing out on rising repatriation concerns, collapsing front-end funding. LIBOR OIS contagion, as spread blows out, it starts to infect other markets. LIBOR OIS blows out as LIBOR rises above 2% for the first time in 10 years. However, while the overall move wider was expected, the speed of the blowout has taken most analysts by surprise, and the result has been a scramble to explain not only the reasons behind the move, but its sharp severity. While this is a simplification of the various catalysts behind the spike in LIBOR OIS, here is a quick summary of what is going on. The expansion of LIBOR OIS and basis swaps have been impacted by a complex array of factors, which include 1. An increase in short-term bond T-bill issuance. 2. Rising outflow pressures on dollar deposits in the U.S. owing to rising short-term rates. 3. Repatriation to cope with U.S. Tax Cuts and Jobs Act, and new trade policies, and concerns on dollar liquidity outside the U.S. 4. Risk premium for uncertainty of U.S. monetary policy. 5. Recently elevated credit spreads of banks. 6. Demand for funds in preparation for market stress. In recent posts, we have taken a detailed look at each of these components, of which 1 through 3 are the most widely accepted, while bullets 4 through 6 are within the realm of increasingly troubling speculation and suggest that not all is well with the market. In fact, quite the contrary. It's not just rates. The consequences of rising dollar funding costs will eventually impact every aspect of the fixed income market, even if simply taken in isolation, due to the ongoing spike in 3M LIBOR, which still is the benchmark reference rate for hundreds of trillions in floating rate debt. The reality, however, is that without a specific diagnosis, what is causing the sharp surge wider, and thus without a predictive context of how much higher it could rise, and how it will impact the various unsecured funding linkages of the financial system, it remains anyone's guess how much wider the LIBOR-OIS spread can move before it leads to dire consequences for the financial system. Thank you for watching this week's Sand to Pirls Stock Market Commentary video featuring the proprietary bull-bear point and figure market breadth summary chart compiled by Donald Pirl, www.s2pmarketsignal.com. Hoping that you enjoyed a peaceful and pleasant weekend, that your week is proving to be prosperous and productive, and wishing you true success.